The unemployment rate still looks stable, but that stability is starting to hide a softer labor market underneath. And that matters because when headline unemployment stays calm while labor demand is quietly deteriorating, the Federal Reserve faces a rising risk of holding policy too tight for too long. The core issue is that unemployment is a lagging summary statistic, not a clean real-time measure of labor market health. A stable jobless rate can coexist with slower hiring, fewer job openings, weaker hours worked, lower voluntary quits, and a growing share of workers who stay employed but lose bargaining power. That is the setup the market should focus on. The labor market does not usually break first through a sudden jump in unemployment. It often weakens through reduced hiring intensity before it weakens through outright layoffs. Firms initially respond to slower demand and higher financing costs by freezing expansion plans, cutting overtime, delaying replacement hiring, and becoming more selective in recruiting. That does not immediately push large numbers of workers into unemployment, but it does reduce the underlying flow of labor demand. Over time, that slower flow matters more than the steady headline rate suggests. This is where Fed policy risk increases. The Federal Reserve has spent this cycle trying to cool inflation by restraining aggregate demand through tighter financial conditions. Higher policy rates feed into more expensive credit, weaker interest-sensitive spending, and tighter corporate hurdle rates. But the transmission works with a lag. Companies do not instantly cut payrolls when rates rise. They first absorb margin pressure, then slow investment, then reduce hiring, and only later consider deeper labor cuts if revenue softness persists. Consumers follow a similar sequence. They do not immediately retrench after policy tightens. They gradually slow discretionary spending as debt service rises, savings buffers fade, and income growth becomes less secure. That means labor market softness can build for months beneath a stable unemployment rate while the cumulative drag from prior tightening is still moving through the economy. The risk for the Fed is interpretive. If policymakers lean too heavily on the stable unemployment rate, they may conclude that labor demand remains too firm and that policy is not yet restrictive enough. But if the more cyclical internals of the labor market are already weakening, that conclusion can be misleading. A labor market driven by low firing and weak hiring is very different from one driven by healthy churn and strong demand for workers. In the first case, the unemployment rate can remain deceptively calm because fewer people are losing jobs, but fewer people are finding them as well. Once hiring slows enough, even a modest pickup in layoffs can push unemployment higher quickly. That is the nonlinearity the market tends to underestimate. Labor markets often look stable until they do not, because hiring weakness reduces the system's shock absorption before layoffs become visible in the headline data. That creates a specific policy hazard. If the Fed waits for unemployment to rise materially before adjusting its stance, it may be reacting after the labor market has already rolled over. The lag between policy restriction and labor deterioration means the central bank could still be applying pressure just as private sector demand is entering a more fragile phase. And because labor income is the main support for household consumption, a softer hiring backdrop eventually feeds into weaker spending, slower revenue growth, and broader disinflation. In that environment, the Fed's effort to keep inflation contained can become self-reinforcing in the wrong direction. Tight policy weakens hiring, weaker hiring softens income growth, softer income growth slows demand, and slower demand eventually exposes more labor slack than the unemployment rate previously showed. For markets, the first implication is that equities face a more complicated macro mix than the headline labor data implies. Early in this process, stocks can remain resilient because stable unemployment supports the idea of a soft landing. But if investors begin to recognize that labor softness is building beneath the surface, the market narrative shifts from resilient growth to late-cycle cooling. That tends to pressure cyclical sectors first, especially those tied to consumer discretion, small business activity, and labor-sensitive margins. Earnings expectations become vulnerable not because the economy is already in contraction, but because revenue growth and pricing power become harder to sustain when hiring momentum fades. The second implication is for bonds. If the market sees rising odds that the Fed has already done enough, front-end yields can start pricing a higher probability of eventual easing even before unemployment clearly rises. In other words, hidden labor softness is bullish for duration before it is obvious in the standard labor headlines. The forward signal to watch is whether labor weakness remains concentrated in slower hiring or starts to migrate into layoffs and higher unemployment claims. That transition is critical because it tells you whether the economy is absorbing tighter policy gradually or whether the delayed effects are now becoming visible in the headline data. If stable unemployment continues to coexist with weaker hiring, softer wage pressure, and cooling hours, the Fed's policy risk rises further because the labor market is doing more disinflationary work than the headline rate acknowledges. The market should not wait for the unemployment rate alone to validate that shift. By the time it does, the Fed may already be behind the curve in recognizing how much softness has been building underneath.